Good afternoon. It's Chris Robinson, Robinson Ag Marketing. Today's Thursday post-close comments for the grains and the livestock for July 16th. Well, is it over, right? Is it over? Is the rally over in corn and beans and wheat on last night's spike? And is the sell-off over in cattle? We'll find out tomorrow. Friday is going to be a big settlement day. Key areas hit last night in D's corn. I can't stress this enough. They've all been in the letter. And it's not like it's a secret sauce I have or anything like that. I do the homework, right? I show you where the 50, 100 day, 200 moving averages are at D's corn. Why did we go right to 73 and a half last night? Hit 74 and a quarter and then finish the day down at 64, a dime lower. The robots, right? I can tell you this: if I'm bullish corn, we really, really need to see us settle above that 100-day moving average for the week. We have had a great recovery. We were down at 426 on June 30th. You do the math: 426 to 474. That's a good chunk of real estate. Now, yeah, I know it's not $5 and it's not $6, and I get a lot of stuff on social media where corn should be at $7. It doesn't matter where you think corn should be. If you look at the price of D's corn for the past 3.5 years, the life of this contract, 469, 470, it's right in the middle of the available prices. So have things been better? Yeah. Are we going to get back up to 512, the old all-time high? I sure do hope so. So far this year, all we were able to muster was 506. So anything above 481 is a good sale. We did get to 474. Is that 6 cents? Is that going to stop you from making what could potentially be a better cash sale? So if you've been working with me all year, you know our cash sales are at 488. But depending on when you come on board, I'm not going to sit here and tell you not to sell corn around 474 or 480. Why not? I mean, it's where you want to be given the available prices we've had. Same thing with Novi beans. Are you telling me that you don't make money at 11.95 beans when 14 days ago we were down at 11.25, and we've had three moves from of a dollar so far this year in Novi beans? I sent out a text message today for guys that I know that didn't have puts on for beans or left their puts down at 11.10. You can protect 11.80, 11.70, 11.60 till the end of August for 10, 12. I think the most I spent was 18 cents on some 11.80s. And why would you do that? Well, because there's 80 cents worth of risk here if we go back down to $11. So nobody wants that without a hedge. The wheat, last night, SEP wheat almost hit $7, which would have been the contract high going back in May. We hit 98 and a quarter and then fell out of bed, settled down only 2.75 cents though. So still relatively good position for wheat. Same thing with Kansas City. Finished the day only down 3.5 cents, but it was 15, 16 cents off last night's spike high. If you know me at all, you know I hate the overnight trade. I think it's a necessary evil. It's more of an evil than a necessary one, but we're going to have to slug through that forever. Everybody has to deal with it. We'll see if we get in any sort of nonsense tonight in that market as well. Because what you have is the Europeans and the Asians basically have free hand to run the table if they want to, because a lot of people aren't participating. I mean, who wants to be up at 2 o'clock, 3 o'clock in the morning trading? I wish that we go back to where we were 15, 16, 20 years ago when there was no overnight trading. You came in and you dealt with all of your trade that 4 hours during the day. I think it was a better system. It's just leaves the door open for too much garbage trade overnight, too many big swings, too many, we call these worm programs that they go out and they run and I mean, now with AI, they're like, okay, where do we think all of the stops are? Buy stops, sell stops. They just go run and hit those stops and trigger them off and trade around them. So I'm not a big fan of the overnight trade, guys, but it is what it is. So we do have to get through that through Friday. Keep those levels in mind: 73 and a quarter, the 100-day moving average. But again, we've been talking about that in the letter for, I don't know, 5, 6, 7 days. As soon as it looked like we might have a chance to go up there and test it. Even if you've gotten nothing sold all year, I mean, the high of the year for November beans is 12.14. We got to 12.06 and 3/4. You can't tell me that 11.95 isn't a good price. Um, I don't know what to tell you. And again, you are already trading you're already trading if you're growing bushels in the field, right? So you already have risk. What I'm looking to do is mitigate that risk by having you reward 80-cent rallies with cash sales if you need them, or with a substitute sale with a cheap put. That's really what it comes down to, because 2 weeks from now, if we're back down to 1120, you're going to wish you had spent some money on an 1180 or 1160 put. Now, vice versa. If we miraculously rally and we're back to 1230 or 1240, the contract highs, are you going to be mad because you gave up 10 or 12 or 15 cents if we can rally another 40? That's the way you have to look at marketing, in my opinion. So that's always it is always a business decision that you're making. And let's face it, you've already made the biggest business decision, which is that you decided to get long grain because you're a farmer. All right, switching over to the cattle. Good Lord, another lower day. August down $3, 227, traded as low as 226 in the fat cattle. August feeders traded as low as 343.60. Did manage to finish $3 off the low. Is it overdone? Absolutely. Can it go even lower? Absolutely. If I'm looking at August feeders, you got to worry about that June 4th New World Screwworm low, which was 336. I mean, today's low was 343.60. So $8 more. Can we do that? I don't know. Anything's possible. So if you have puts on, great. Look to roll them down, because what you don't want to have happen is if you paid 4 cents for a put, now it's worth 12 or 14 or 16. You don't want a 16-cent put to go worthless if we turn around and rally. So roll those puts down if you can. I'm not telling you to lift your puts, but at some point we're going to rally, and it'll be nice to have taken a chunk off the table if your puts have gained in value. So it's always a judgment call if you roll them down. I've seen it time and time again, doing this for 30 years, where somebody has a put on, it's tripled, quadrupled. I'm like, no, I'm holding it till the bitter end. And 2 weeks later, the put that you paid 10 cents for, that's worth 70 cents, is worthless again. And people are saying, oh, I hate these puts. No, you've got to manage the value of the puts when they double or triple or better like that. That's all I can tell you, because if we rally, which is what you want, because you're long these animals, you want a cheap put to go worthless, not an expensive one. So keep that in mind, guys. Lean hogs were able to finish higher in the deferred months. Still, if you take a look at that stuff in the deferred months, which I've been looking at, Feb's, it's trying to put a bottom in. We've had a lot of volatility. Another move higher today, though. Feb cattle looks like it's definitely trying to come out of the doldrums. As far as that retracement, we had a break in Feb cattle from 87 back in May. All right, middle of May, we dropped all the way down to 76 and change. You're going to be mad at me, but today's high was 81.70, and that is, you guessed it, halfway back. So hogs are trying to turn the corner out there. Hopefully they can drag the cattle with them, but a very big technical move out there in those deferred hogs. All right, this is Chris. Have a good day. If you're looking for help, give me a call. If you're not getting my letter, just remember, I spend an hour and a half, 2 hours a night doing the charts, so you don't have to. If that's something you're interested in, give me a call.